Well, good afternoon, everybody. My name is Eric Levinson, Head of Business Development for VinaCapital. Thank you very much for joining us for our 2023 Outlook webinar. I'm going to be joined this afternoon by my colleagues, Michael Kokolari, our Chief Economist, and Ismail Pili, our Head of Research. This afternoon, we're going to conduct a brief review of what happened to the market in 2022, and it's been the bulk of our time with a focus on our outlook for 2023. Now last year was certainly a crazy year for the market in U.S. dollar terms, down roughly 35%. Now, it's interesting, we began last year with what I would say cautious optimism or even pretty good optimism. In the first quarter, while the rest of the world was struggling, Vietnam was basically flat. And it really wasn't until the end of the first quarter where there were two high-profile CEO arrests that really derailed the stock market. And this put significant pressure in both the real estate sector and the banking sector, which are the two largest sectors of the market. Having said that, then the global pressures added. We had supply chain disruptions, inflation, the U.S. Fed. And so last year, where we were looking at what was going on outside of Vietnam as putting pressure, it was really things inside of Vietnam that actually impacted the market in a more meaningful way. We had a third arrest in the beginning of the fourth quarter, the CEO of VTP, and that really sent the market really struggling a bit more in the fourth quarter. Now, having said that, we actually believe the worst is behind us for a variety of reasons. And what we actually saw towards the end of November and early December is that foreign investors recognized that PE ratios at 9 times forward earnings, that the market started to find a bottom. And so we might still, and we expect to see volatility in the next couple of months. We do believe the worst is behind us. If you actually look at foreign flows, Vietnam was kind of negative for the first 10 months of the year and then became a large foreign inflows the last 2 months, which turned that tide. And so we begin 2023 with, again, a new sense of cautious optimism because the economy continues to grow, and then on the market side, valuations are cheap. Now, as we begin our 2023 outlook, let's just take one last look back on what our forecasts were for last year and how did we do. Well, as we look back, we got most things right. We did forecast a strong economy. GDP was 8%. That was out of consensus at the time. We were projecting that. We also predicted low inflation, came in at roughly around 3%, strong inflows for FDI, strong domestic consumption, higher volatility of the market. We would have thought that volatility would have been more on the upside than the downside, but we certainly forecasted volatility. Lower exports to the U.S. Was really a push, and Michael will talk more about that later. The two things we got wrong, which you could easily argue were the most important things, were the stock market performance and the VND appreciation. And what we'll see on the next slide on what we didn't foresee is really what drove the market down lower. So what we didn't foresee was Russia-Ukraine. We didn't forecast the U.S. Fed really being aggressive in terms of rate hikes, continued COVID lockdowns in China, the domestic issues, and that really impacted the market where there's 3 arrests from FLC, THM, and VTP. And that resulted in a credit crunch in the real estate sector and problems in the corporate bond market. And then really, which led to where we are today, really, which is really historically low valuations. So that's kind of the report card on our forecasts. Now, I think what the real report card is on fund performance. So how did we do? So for our offshore funds, actually pretty well. Now, I don't think anybody's going to be too excited about negative performance, but the reality is we did a really good job of managing the risk. VOF, which is our London-listed closed-end fund, combination of private equity and public equity, that was down 24.4% in USD terms versus the index at 34.1. That includes dividends. 3-year record of 10% versus 2.5%. So again, delivering alpha in the short term, medium term, and long term. VVF, which is our Luxembourg-listed UCITS fund, down 23.5% versus the index at 35.1, and that's in simple terms. 3-year 12% versus 0.9. So again, in 2021, we delivered outperformance when the market was up. In 2022, the market was down. We maintained our roughly double-digit outperformance. And then VAF, our Cayman feeder fund, negative 24.8 versus 35, 3-year at 12% versus 0.9. And so again, for our offshore clients or for folks that are looking at us debating on VinaCapital, we've been able to outperform in down markets and up markets. And I think that's really a fantastic value proposition. Now, We also want to show our local funds, just to highlight that it's just not one specific product set where we deliver this performance to clients. Our two domestic equity funds, VEOF and VSAF, this is in VND terms, down 21 versus 32.8, down 24 versus 32.8, and then the 3-year up 12.7 and 16.6 versus 1.6. So again, really, whether it's an offshore fund or a local fund, our equity funds have done extremely well. Our balanced fund, which is 50-50 equity and debt, down 10.5 versus 13, 3-year 10.9 versus 3.6, and then VFF, which is our bond fund, 8% versus 6%, and then a 3-year 7.1 versus 5.4. And so our portfolio managers, our research team, have really done a fantastic job being able to navigate the market. And so I think it's important when we talk about what VinaCapital does, oftentimes we talk about Vietnam, we talk about consensus, we're active managers. The active share of our UCITS fund is roughly 65% on average. And so we'll talk about consensus, we'll talk about views on Vietnam. It's really important, we'll talk about this more in the presentation in Q&A, that our view is often different than consensus view, and that's really how we drive alpha. Okay, so now that we're done with the intro, I'm going to introduce my colleagues, Michael Kokolari, he's here with me in Ho Chi Minh City, and then Ismail Pili will be joining us live from Canada. I say live because depending upon how you look at the world, it's either extremely late or very early in the morning in Calgary. So Michael, thank you so much.
Thank you, Eric. So we expect Vietnam's GDP growth to fall from 8% growth last year to 6% growth this year. That 6% forecast is in line with the consensus. Eric mentioned that last year we were way above the consensus. This year we're kind of in line with the consensus. And it's the 6% figure is also more or less in line with Vietnam's long-term growth trajectory. So Vietnam's economy grew by around 7% on average pre-COVID. We expect similar growth in the next post-COVID. So we'll be a little bit lower than the long-term growth trajectory. And we can think about 2023 as kind of like a renormalizing year. So 6% growth this year. What the point of this slide is, and much of what my presentation today is going to be, is to explain how do we go from 8% GDP growth last year when we had this big COVID reopening boom to 6% this year, because we have a number of factors that are sort of pulling in different directions. And I've identified the main factors that we think will either support the economy or that will pull the growth down. One of the most important ones you see at the bottom here is that the slowdown in the global economy. You will certainly be aware of the fact that a big part of Vietnam's success story is manufacturing products here that are then exported to the US and to the EU. This is the so-called East Asian development model. So the slowdown in growth around the world will be something that is one of the biggest factors that pulls our GDP growth down. And then I have outlined here the other things that will support us. One of the things that will really help support us a lot will be a continuation of of tourists coming back to Vietnam. I say continuation because that had already really started in 2023, and we see that continuing this year as well. That will support GDP growth and the other factors here that I'm going to get into in this presentation. So here we see what's going to boost growth, what's going to pull growth down. What I've done on the next slide is instead of putting these arrows, I've actually put numbers to what I think each one of these factors, how much it's going to. And again, remember what we're trying to explain here is how we go from 8% growth last year to 6% growth this year. So this is kind of a decomposition of the pluses and the minuses. And on the third slide, what I do is we're still on the same topic, but what I'm doing is I'm drilling down into more detail about how did we get those numbers. So for example, you see, and the circled area here is like where all the action is. So you can see here, we're expecting manufacturing to slow from 8% growth last year to basically 0% growth this year. And if you go back to the last slide, that will be a minus 2 percentage point hit to GDP. So this is a decomposition of where we see everything impacting the economy. What I'm going to do now is, for the main most important factors, is I'm going to get a little bit into the story behind each of these. And I will also mention that we'll be publishing a report next week in which we also kind of go through the factors, how we came up with these forecasts and the story behind them. So if you like to get your information in written format, you'll have that available as well. So this is a summary of the main factors. And the first one is what I just mentioned, manufacturing. You can see we've had a big drop-off in manufacturing growth starting from the middle of last year. You may know from reading the Wall Street Journal and the FT that the inventories of consumer-facing firms, retailers, firms like Nike, et cetera, surged by 20% last year. And consequently, what we see is towards the end of 2022, in the US, their imports of consumer products, things that are made in Vietnam, also made in China as well, have already started plunging. There was a record drop in US imports of consumer goods in the month of November. Consequently, what we're seeing is that the orders in Vietnam factories are now shrinking because the demand in the US has rolled over already. Vietnam's PMI was under the 50 level over the last 2 months of 2022. I would not be surprised if the PMI stayed under the 50 level for most of this year as the demand from US consumers rolls over. That having been said, on the next slide, I'm going to briefly discuss kind of an interesting dynamic, which is on the one hand, you see the graphic on the left. This is a recycled slide from our Q2 webinar. So back in the middle of last year, we had already kind of correctly forecast that the demand for big ticket products, things that are made in Vietnam and China, was already rolling over. But what also happened is that more and more factories are moving from China to Vietnam, or setting up in Vietnam instead of setting up in China. So you have this phenomenon that Eric, I think, puts a really good term on it. He calls it the dueling headlines. That on the one hand, demand for products that are made in Vietnam is slowing, but on the other hand, because of the US-China trade war, because of the China's COVID lockdowns, et cetera, more factories are moving here. So actually, manufacturing sector has been more resilient than we thought last year. And the other part of this story is that, of course, we have more and more FDI coming, and more high-quality FDI. This slide, by the way, about FDI is usually something that I reserve when I talk about the longer-term growth story of Vietnam. But the reason I'm including it in this discussion about, how do we go from 8% to 6% is because this actually turns out to be a meaningful factor that's supporting our growth right now because so many factories are coming here. So that's a summary of the story of manufacturing. Vietnam's tourism sector will benefit tremendously from Chinese tourists coming back. Chinese tourists were about 1/3 of our total tourists pre-COVID, and foreign tourism contributed about 10% of our whole economy. So I have been forecasting for some time that Vietnam's economy would get about a 2 percentage point boost from Chinese tourists coming back. This red line is my forecast, which I've been made a couple months ago already. The gray bars that you see here, this is a forecast that came out from Goldman Sachs last week, and Goldman's is predicting, they don't look at Vietnam, but they predicted what the impact on the GDP growth in some other countries in the region will be from Chinese tourists coming back. And you see we're kind of right in the middle. With tourism in Thailand is much bigger part of the economy than it is in Vietnam. So our forecast kind of makes sense. I felt comfortable when we saw Goldman's come out with that. So the main impact, the summary of this slide is that the main impact, the main benefit Vietnam will get from China's reopening really is via the tourism. There'll be some other industries that benefit, but Vietnam, recall, has a big trade deficit with China. So again, the main benefit will be from tourism. On the next slide here, I mentioned that the government is signaling that they want to do a big surge in infrastructure spending this year. In 2022, the spending was around 20 billion, maybe a little bit less than 20 billion. I say around because they're still kind of tabulating the numbers. And they've guided that they're aiming for 30 billion of spending this year. There's a number of high-profile projects that have already kicked off in this. We're only a few days into the new year. We've already had headlines. These headlines are all literally from the last few days. And the main point I want to highlight here is that the government, when they talk about spending $30 billion on infrastructure in 2023, they have more than enough financial resources to accomplish that. The government has raised a tremendous amount of money in previous years, which is earmarked for infrastructure and didn't get spent for one reason or another. And so it's just basically sitting in the bank. So the big pile of money that they can afford to spend on infrastructure. And the government's debt to GDP ratio is below 40%. This is kind of unheard of in the world these days. This is a very, very low figure. So they have ample financial resources to boost infrastructure spending this year. And finally, I'd mentioned at the very beginning of my presentation, that first slide, I had the arrows up, what's going to benefit us, the arrows down, what's going to hurt us. And then for domestic consumption, I had this kind of sideways neutral arrow. And the reason why is that basically what we see happening starting this year and certainly over 2023, 2024 is domestic consumption going back to its kind of pre-COVID growth trajectory. And this slide, which was a really good idea, this was actually Eric's idea, was to highlight the GDP per capita over a long time horizon. Obviously, GDP per capita is what enables consumption, right? And what you see is over a long time horizon, COVID, it almost doesn't even show up on there. It's just a tiny blip. So the point of this slide is to say that these long-term growth drivers that have been supporting growth in Vietnam, supporting personal income growth for such a long period of time, they're just coming back to be the dominant factor again. And the most important ones, of course, are urbanization and demographics. These are things that we've talked about many times in our webinars, and those are kind of reasserting themselves as the most important factors that are supporting consumption. Side note on demographics, Vietnam and India are two of the only countries really in the world, two of the only big countries in the world in which demographics is a plus. It's actually pushing up consumption, it's pushing up GDP growth. Most other countries around the world, this is a net minus. So this is something that supports this long-term consumption growth story. I want to end my presentation just briefly talking about macro stability and starting with the discussion on inflation. Inflation averaged about 3% in Vietnam last year, which as you can see is much lower than most of our peers and countries around the world. Long story short, if you really, really strip it away and you think about it in a very clear way, the reason why inflation surged in most countries around the world is because governments around the world printed a lot of money and then actually spent the money or gave it to their citizens to spend. And that essentially did not happen in Vietnam. You see here, Vietnam, the amount of money we spent in this country responding to COVID was fairly small compared to the rest of the world. And the reason why is we didn't need to, because the economy is intrinsically strong. And so as a result of that, that kind of helps to explain why inflation in Vietnam is fairly modest. I do expect inflation to tick up from around 3% this year on average, last year, 2022, to 4% in 2023, and that would be primarily driven by the China reopening. So China's reopening will push up energy prices, will push up food prices, and so we'll get a little bit higher inflation here in Vietnam as a result of that. Next, you can see on this chart, which started just before COVID, that the value of the Vietnam dong, which is in the red chart here, was remarkably resilient all the way through COVID and even a little bit after COVID. The gray line here is Vietnam's regional peers, Philippines, Indonesia, Malaysia, and Thailand. And what you can see is that the value of the dong had remained really remarkably resilient for most of 2022. And then finally, we had this just amazing near 20% surge in the value of the US dollar. Finally, the dong capitulated and it depreciated. But when it depreciated, you can see here that Vietnam's peers depreciated by a lot more than we did. So if you look at the depreciation in numerical terms, was almost, our peers depreciated by almost three times as much as we did in this year, in 2022. And then finally, we had this nice rebound in the value of the dong after the China reopening, because we're going to have tourists coming back here, and also because the State Bank of Vietnam hiked policy interest rates twice by 100 basis points each time. So big increase in rates, and that was to support the dong. You saw on the last slide, inflation is relatively modest, so them hiking policy rates in Vietnam was primarily to support the dong. We expect about 2 to 3% appreciation in the value of the dong this year. And that kind of leads nicely into the very last slide, which is just a brief synopsis of all the key forecasts that I've made here. So you see GDP growth falling, inflation ticking up, and the dong, after having depreciated last year, we should have a small appreciation this year. Okay, so that's everything that we're expecting to happen with the economy. And at this point, what I'm going to do is hand it over to Ismail Paley, our head of research, who is going to discuss kind of how all of this and other factors factors into what we expect for the stock market in 2023.
Thank you, Mike. The rosy picture Mike paints makes us optimistic that it will translate to the stock market performance, which wasn't the case last year. Still, we believe the VNI will finish higher than 2022's 1,007 level and think the bear market will end in 2023. Brokers are thinking the same thing, with consensus seemingly hovering at a 1,300 level, which is roughly 29% higher than year-end 22's level. In our view, instilling confidence back into the stock market will be a drawn-out process that requires addressing global and domestic factors, in which we think the domestic issues will hold greater sway to Vietnam's market performance. Moderating inflation, the Fed taking a less aggressive stance, and avoiding a deep recession are factors facilitating a risk-on mode that benefits global equity markets, including Vietnam. Going into 2023, a cautious outlook is the general stance adopted by most global investors. We are, however, optimistic on global markets this year and think major indices will close higher than year-end 2022 as markets look forward to the eventual economic recovery premised on a shallow recession. Our thoughts on global equity markets this year are as follows. We're closer to the end rather than the beginning of central bank's rate hiking cycle. We anticipate global inflation will continue to moderate and the global economy will slow. Second, we expect near-term volatility. The ebb and flow in sentiment from deemed favorable and unfavorable data points pertaining to inflation, employment, and economic data will see shifts in central bank posturing on its monetary policy intent that will likely stoke near-term market volatility in and outside Vietnam that we think will prevail for a good part of the first half. We are also more upbeat in the second half. We expect to see greater clarity and certainty on the current global macro issues. We're in a scenario of lower inflation, a pause in rate hikes, and slower economic activity if not recession is envisioned. This should lead to a more favorable policy support of global equity markets in general, inclusive of Vietnam, and the forward-looking nature of markets suggests sentiment should turn more favorably well before economic data reveals the global economy is on an improving track. Domestically, this lack of animal spirits among the local investor base can be attributed to the overhang created by domestic issues around the anti-corruption investigations, the corporate bond market development, and the high interest rates. An environment that could get domestic investors back into the market includes the absence of high-profile big business arrests, rectifying the corporate bond refinancing risk, and lower interest rates. In the more immediate horizon, the usual argument for Vietnam's market's appeal remains. It does emanate from its cheap valuations and decent earnings growth, underpinned by its fast economic growth and favorable macro factors. This picture wasn't lost on the foreign institutional investors last year, as they ended up as net buyers, primarily from November to December. And we think this appeal for overseas investors will remain in 2023, further alleviating some of the selling pressure in our belief that margin selling pressure has largely abated. On this slide, we have to think about the risks. Not everything is going to come up roses, of course. And we simplify this list by citing 3 domestic risks and 3 exogenous risks. The first risk is additional anti-corruption investigations arrests. We saw last year how those 3 high-profile arrests shook the market and led to the market tumble. The second risk is a corporate bond refinancing. Those arrests undermine the companies connected to those individuals, particularly the VTP case in October, and unearth the risk of sizable maturing bonds coming due in 2023 and 2024. Coupled with regulatory changes in the bond market that made future issuance tougher to do, the uncertainty of refinancing those maturing bonds remains an overhang to the market, given the implications on the 2 largest sectors in the market, which is real estate and the banks. The third risk is higher domestic inflation. We're expecting an average 4% for 2023, up from 3.2% in 2022. But China reopening could add pressure on food and energy prices to Vietnam's outlook, and the ramifications that would have on consumption and interest rates is something we should be aware of. On the exogenous risk, U.S. inflation numbers have been coming down, and we're waiting on the December number tomorrow. The moderating trend is visible, though still worry if inflation persistently remains high instead. The strong U.S. dollar is always a detriment to emerging markets. The weakening of late of the USD or DXY can be linked to the EM's recent outperformance, notwithstanding China's bounce post its reopening announcement. And finally, geopolitical issues is an event play that's difficult to predict, be it the Russia-Ukraine situation, US-China tensions, or noise around the Gulf and OPEC. These are things that could affect Vietnam as well. On this next slide, they always say that you gotta know where you've been to know where you're going. And so with that, we look back at how Vietnam market fared last year. We all know right now that Vietnam's stock market in 2022 was probably one of the weakest around the world, despite the fact that the country had very strong economic standing. It fell 32.8%, 35.1 in US dollar terms. It was the second worst performance since its inception after 2008, and among the worst in investable Asia after Sri Lanka, which is of course dealing with their own financial crisis. Vietnam's laggard performance has largely been attributed to domestic issues rather than the global factors. South Asian peers actually did relatively well, especially in local currency terms, led by India, which is up about 5%, Indonesia and Singapore both at about 4%, and Thailand up by about 1%. ASEAN overall rose about 1.1%. If you're measuring in US dollar terms, it's down about 3.8%, and North Asia fell about 15.4%, 21.7% in US dollar terms. On this next slide, very briefly, we look at the sector performance last year, where we see that every sector was in the red in 2022, with IT, utilities, and consumer staples holding up best. NBFCs, the brokers and insurance, materials, real estate, industrials, and energy had the worst performance. We pay particular attention to the banking sector, given its oversized weight in the index, and we find that it fared relatively better, with about 22% correction versus the Vietnamese 33% decline. However, factoring in the sector weights against the performance, we find that it is indeed the big sectors that were the main drag to the index. These were real estate, banks, materials, and industrials. On this next slide here, it further delves into the sector performance. The right-hand side table shows the performance of the sector and the sector's associated beta. Actually, left-hand side, I should say. As we should typically expect in down markets, defensives are expected to do better. And in Vietnam, these were IT, utilities, and consumer staples. And indeed, these sectors were associated with lower beta and better relative performance. Sharper corrections were generally seen with higher beta sectors, such as materials and energy. Sectors that in Vietnam had higher betas. The right-hand side further reflects the risk-off environment at play in Vietnam. Though the VNI fell 32.8%, the mid-space had an even worse showing. The VN mid-cap, represented by the VN70, was down about 41.4%. Even worse, though not depicted, is the VN small-cap sector, which was down about 51%. In risk-off mode, investors will indeed gravitate towards bigger-cap blue-chip companies. On this slide, we're looking at the cheap valuations that Vietnam has to offer. At about 11 times PE, it's generally well known that the Vietnam market is cheap relative to their historical average and to the region. Its underperformance the past year has also seen its discount to the regional peers further expand. Foreign institutional investors, which tend to be associated with longer-term horizon, appear to recognize the buying opportunity presented by the price on offer by the Vietnam market, as we think valuations was one reason we saw foreigners come in during November and December, to the point that we saw net foreign inflow last year anew since 2019. On this chart, on the right side, we see that for FY23, Vietnam is forecasted to post faster growth than its regional peers, with consensus estimates for 2023 at 7.9 versus the 5.4% average for the ASEAN market. On the left-hand chart, estimates has, however, been declining, although our forecast for our coverage universe is higher than consensus estimates at about 16%, due in part to our active bottom-up approach to the market, focusing on the fastest growing sectors and companies. We also think that consensus is anchored a little bit too low. Just delving a little bit in terms of the market estimates for Vietnam in terms of the fall on account of the weaker economic growth outlook, both here and abroad, as well as domestic and sector-specific issues. Based on our coverage universe itself, our net profit estimates at the end of 2022 versus the start of the year actually also fell to about 21% from about 24% for 2022 and to 16% from 26% for 2023. For both years, the sectors that saw the biggest cut in our earnings estimates were materials, real estate, and consumer discretionary, while sectors that saw higher forecasts were aviation, oil and gas, utilities, and IT. To some degree, this spate of earnings cuts and upgrades was somewhat reflected in the sector performance we discussed a few slides back. As we do believe that earnings tend to lead markets, multiple expansion to follow, upgrades to forecast is what we want, and this may come from stronger than expected domestic consumer, inclusive of the impact of international tourism, a strong rollout of the government's infrastructure spending plans, and the extent that the global economy recovers. We should note that current global growth forecasts were made in early fourth quarter 22, when data points had higher oil prices, little visibility on China's reopening, expectations of high Europe energy demand, and elevated wage growth. This one's a very interesting slide. As mentioned at the start, we think the VNI will finish higher than 2022. We think the bear market will end, notwithstanding our expectation of continuing volatility early in the year and lingering concerns about corporate earnings growth. As I said, brokers seem to be gravitating around the 1,300 level by year-end 2023. Again, this chart is suggesting that if history is anything to go by, the bull market that follows the bear market is longer and stronger than the down period that preceded it. The phenomenon is not isolated to Vietnam. If we draw a parallel with the U.S. experience, the average bull market there lasted about 8.9 years with an average cumulative return of 468%, while the average bear market lasted about 1.4 years with an average cumulative loss of about 41%. What would make the market rebound this year then? Well, those points we mentioned, from value and growth being on offer, the return of foreign investors, and even less margin selling pressure, which we think it has largely abated. And finally, we look at the themes that we've been running with. This is actually something we thought of about several years ago, so some of them will be familiar. Some will be more prominent this year, such as infrastructure and domestic consumption. So we just laid them out here and the potential sector plays. The first one is domestic consumption. Even as Vietnam exits its reopening boom and enters the mid-cycle stage, domestic consumption remains a constant feature. Banks, brokers, consumer discretionary, and real estate will be the sector plays. China's reopening may further enhance this theme, particularly for the aviation sector. And infrastructure. This has been a perennial theme for Vietnam. The expected boom in infra spending this year puts this at the forefront for investors. Airports, industrial parks, materials, real estate, and utilities are some of the more direct plays, while SOCBs can also be considered. The other three themes: lower rate beneficiaries. You can see the beneficiaries in terms of brokers and real estate. FDI, that's been a structural feature of the country and remains as relevant now as it was years ago. IP, consumers, ports and logistics, real estate, and consolidation. A tougher operating environment may spur on some M&A activity involving both domestic and international players. The banks, consumers, and real estate on a project basis are the ones we're keeping an eye on. With that, we'll turn over to Mike and Eric and jump into the Q&A questions. Thank you very much.
All right, well, Ismail, thank you so much. And I guess you are stopping sharing the screen. We'll go live to us. And for those of you that have questions, please put them into the chat function. I see that a couple of folks have already put in questions, so thank you so much, and apologize for the technical difficulties. Ismail, are you still with us? I can't see you, but are you still on the line?
I'm still here.
Okay.
I'm still having issues for the video chat.
Okay, apologies. So, all right, so first question that's coming in. I've got my iPad here with my glasses on. Question from Marielle. This goes to Michael. How realistic is the increase, kind of 2% GDP growth this year due to infrastructure spending, given the historical slowness of the government in deploying such spending?
Well, that's
we talked about this earlier.
This is a very savvy question. Good kudos to you for asking that question. You saw that in my presentation, I was really emphasizing the idea that they have abundant financial resources. That was the thing I really wanted to focus on. Now, it's true, one of the reasons they have a lot of cash stored up is because of the slow disbursement of funds in the past. One thing I should mention that really did not get a lot of press, so I want to mention this. I thought it would be too many details to have in my presentation, is that in the middle of December, the government passed that was called Decree 1513. And essentially what Decree 1513 said is, here's a list of projects, including this north-south highway, the one that I had the headlines on in my presentation. Here's a list of projects that really need to be done in this year, in 2023. And the amount of money that those projects equates to is about $15–16 billion. So they were kind of doubling down and saying, in a way, it's like you say, this is my plan, but then you come out with another law that says, and I mean it, this is really my plan. So that made us feel more comfortable. The other thing is, if you go back and look at the slide where I made the predictions of all the individual components, we were a little bit fuzzy because we put the numbers what the government was saying. They would go from 4% of GDP to 7% of GDP. But if you look a little bit closely, we're only assuming that would add 2% of GDP worth of GDP growth. In other words, we listed the government's official figures, but we kind of put a little bit of a haircut to it. So we think that our prediction that infrastructure spending will boost growth by 2 percentage points.
So the 2% is your number, not the government's.
It's our number. It's a realistic number, and you'll notice if you look carefully, it doesn't exactly it's under optimistic compared to the government. So good question. Yeah.
All right, we have a few more questions come in, a combination of macro and kind of market. So we'll go to Ismail on this. So Ismail, you spoke earlier about how our forecasts are different than consensus. We didn't really talk about any specific names. So can you highlight a couple of our high conviction stocks in a couple of different sectors?
Sure. Well, let me start off with FPT. It's a company that's held up well in 2022, posting a gain of about 1.3% versus the VNI's 33% retreat. Most of you will know it's a technology or telecom conglomerate with a market-leading position in technology services. It's top 3 market share in Vietnam's broadband internet market as well. They are being driven by their globalization strategy, and they've been able to achieve an international revenue CAGR of 20% over the last 3 years. Overall for the sector that they're in, we're actually quite positive on the long-term outlook on Vietnam's technology sector behind the booming IT spend. And in that regard, we especially favor the software outsourcing companies like FPT as cost competitiveness. Specific question, we do think FPT will still maintain more than 20% net profit growth. The company is still gaining market share behind their strengthening technology capabilities, and they continue to benefit from their low cost advantage. Someone said they're probably roughly 20% cheaper compared to Indian vendors. So that's actually really important in this global corporates tightening budgets.
All right, what about another stock, just from time perspective?
Yeah, for P&J, this one did fantastically 27% gain last year in the down market. The net profit growth is forecasted at about 31% for next year, for 2023. We haven't seen the 2022 number yet, but we're kind of looking at 73%, so it's not a low base effect at all. For those, I think most of you know that it's a leading fashion gold jewelry company, and they're riding on Vietnam's fast-growing discretionary luxury spending. But we do think that for the results that's going to be coming out soon this year for FY22, P&J will probably post very strong earnings growth off a very low 2021. We do think that there's a recovery in discretionary spending still after the peak COVID-19 disruptions, and that we'll see P&J market share continue to gain.
All right, awesome, thanks. All right, a couple of questions have come in, and they're related. So what I'll do is I'll kind of consolidate 3 or 4 different questions. They're all about the real estate sector. So to both of you, Mike, I'll start with you first because you're here and the technology's better. The questions are, when will the real estate crisis end?
Right.
Specifically, how is demand for residential real estate being impacted by potential insolvency of a couple of the companies?
Yeah.
How long will it take for the real estate credit crunch to recover?
Right.
And just kind of when will it recover?
Yeah.
So
actually,
a lot of questions in there.
One thing I want to say right up front is this is the time of the year when we have a lot of events and we give speeches and blah, blah, blah. And this question is coming up at like every event that I give a speech or presentation to. So this is really on everyone's mind. The first very important thing that I really want to make sure that people come away with is that when we hear about issues in the real estate market, very important for you to know that the fundamental demand for new housing products is still sort of way more than supply. So it is really a liquidity issue. It's, this is a very different situation than in China. We get, because China's right there, we often get asked, is there a parallel to the China situation? So unlike in China, where you have like 30% vacancy rate, all these people, with empty apartments and stuff, the problem here is just getting credit to the developers so that they can finish doing the projects that they've already, in process, the things that have been zoned but they haven't been able to go forward. And so the question about the health of the real estate market is really a question about what's going on with the corporate bond market and getting all that functioning again. And that is really more of a kind of a government policy question. One thing I would say on that is that our CEO, Don Lamb, made a presentation to the Prime Minister at the end of last year, and we were heavily involved in kind of coming up with some recommendation. Ismail, our head of research, and I were heavily involved. And we came to the conclusion that these are, I don't want to say easy problems to solve, but they're solvable. So the question about when the real estate market rebounds, number one, the fundamental health is still there. So it's just a question of getting liquidity to the developers. And getting liquidity to the developers is sort of about solving the corporate bond issue. And that's kind of like a government policy type question.
Okay. Now, Ismail, do you have any comments on that as well?
No, I guess maybe just more on the bond side. Distressed bond issuers can face pressure on maturing debts, and that's going to put pressure on the property prices in general. It's just going to be more discounts on property prices, in town. Aside from the highly cared developers, other names would also see a certain level of difficulty from their pre-sales being impacted by the weak buyer sentiment. Again, there's going to be some, concerns about the developers' ongoing status credibility, and also, I wouldn't say stable, but the interest rate environment. The mortgage rates have gone from about 9 to 10% early last year to about 14 to 16% now. And again, that's going to affect the developer pre-sales this year.
All right, thanks. And I'll add one last comment. In comments with one of our portfolio managers, she made a point that one of the real estate companies that was having some liquidity issues actually sold, I believe it was 2 or 3 hard assets, land as well as commercial buildings. And so they were able to then pay off their debt by selling hard assets. So there are multiple ways that companies are solving their own issues without any regulatory or government involvement.
And, not to spend too much time on this issue, but just to elaborate on both what you said and Ismail said. So to be super clear on this, what's happening is the developers, in lieu of having sufficient liquidity, selling some of their projects, that's putting a cap on the prices. But let's be really clear, the downward pressure on the prices is not because of the demand. It's because of sort of the fire sale of some assets, and we think that will all be over by the middle of this year. This is not going to last. Good time to buy apartments in Vietnam right now, by the way.
Right. That's a separate recommendation. That normally doesn't come during a webinar. I prefer people buy our mutual funds.
Okay,
thank you, Michael. All right, a question here on FDI in manufacturing. There's a couple questions came in. So, you had mentioned the dueling headlines, and actually earlier today there was a great example where there was one article from, I don't know, it was VN Express or something that talked about companies laying off workers, and then in the afternoon there was an article on Foxconn and other Apple suppliers trying to hire workers. Is it too simplistic to say that traditional manufacturing is having challenges, but the high-tech manufacturing is coming on? Can the workers just go across the street for a different job?
I think almost. Yeah, when you think about one of the things we're often harping on about the long-term growth drivers is the high-quality workforce, and the high school education system is really strong here, high PISA scores, all this kind of stuff. So, not to oversimplify too much, but when you think about like working in a garment factory and you're doing kind of very small, precise type work, and then you switch to an electronics factory where it's again, I'm sure there's some training entailed in that, but that's basically what you've outlined is what we expect. So the garment stuff is gradually going to Bangladesh, going to,
Or in this case, it's just stopping.
Or just stopping because of the downturn in demand from U.S. consumers we talked about before, but the high-tech factories are hiring,
Okay.
yeah.
Interesting. And are those, I'm assuming here, are those higher wage jobs as well?
Great point. One of the things that came up in the initial stages of the U.S.-China trade war is the garment operators were saying, hey, what's going on? The wages are getting squeezed up like crazy. And that was because high-tech factories were coming in. So this is kind of the other side of that story, yeah.
All right. A question came in about SBV and interest rates. What's your view, and actually maybe this ties into another thing, so maybe expand on your comments on the Vietnam dong,
right.
And then how does that relate to any potential adjustments on interest rates?
Yeah, that's a great point because recall, and I mentioned it briefly in the presentation, the reason that the SBV hiked policy rates from 4% to 6% last year was not because of inflation. Remember, inflation averaged 3%. It really was to protect the value of the Vietnam dong. I had showed that chart where you saw the rebound in the value of the dong, at the end of the year that was driven by the rate hikes, the DXY index coming back down a bit, and the China reopening. What I didn't get into at that time is that it seems pretty clear to us, and we're just starting to get some more information on this, literally as we're doing this webinar, that the State Bank of Vietnam has actually started buying dollars again. So they expended, there's no official number, but they expended a good amount of FX reserves last year to defend the dong and depleting the reserves, and now they're buying back dollars. And so that's one factor that will support the dong, and it also means that they're probably not going to, they don't need to hike rates again this year. So.
In terms of that, is the official policy, and where do you see bank interest rates going in Vietnam? Ismail mentioned mortgage rates at 14%. Do you expect those to come down as well?
Okay, so this is getting into geeky economic thing that I know is
Michael's strength.
Very boring. But long story short, when a country's central bank, so when they buy U.S. dollars, right, they buy dollars from the commercial banks, how does the central bank, how does the SBV pay for those dollars? Well, they pay for the dollars, they have a printing press. So they print Vietnam dong, and they put the dong back out into the economy. They may do a little bit of what's called sterilization to suck some of it out, but basically buying dollars creates liquidity in the domestic economy, and that will be one factor, among others, that helps to put some downward pressure on interest rates. So we do think interest rates are, in addition to buying, our mutual funds, in addition to buying an apartment, if you can lock in, I've heard figures of like, 9% or something for 6-month rates. So that's not going to last.
No, it's not that.
And by the way, when the rates come down and when it doesn't last, you'll see big inflows into the mutual funds. That will be one factor that pushes up the stock market this year.
Yeah, and so a question came in, and Ismail, hopefully hopefully the audio will work better. You mentioned foreign ownership a bit earlier. How is this versus history, and what's your perspective on the potential for foreign flows to come back into Vietnam consistently in 2023?
Yeah, foreign ownership in Jose is around 18.1% now. That's up from sub 17% early 2Q last year, which was a low in recent years. This is still below the 21% share prior to the pandemic. So, there's still some ways to go there. The foreign institutional investors appear to have recognized the buying opportunity that presented by the pricing growth and offer by the market. And we do think that foreign investors can continue to buy up the market as Vietnam, even the region, have a more attractive top-down story. They got better economic prospects with no expected recession in comparison with what we're hearing in the US and other developed countries. And for as long as Vietnam continues to offer relative value.
Okay, excellent, thank you. Now here's a question more on the manufacturing side, so I'll go to you, Michael. Do you have concern for more downside risk for the export sector and the impact on GDP? And how much the market absorbed news about contractual manufacturing in the export sector?
Yeah, I think we really hammered on that on some of the slides in the presentation. I mentioned in one of my slides that I expect 0% growth in the manufacturing sector this year. Look, if things get more difficult in the world economy, there is some potential downside risk to that figure. That having been said, I think Ismail made a good point during his presentation that perhaps the global economy will not be as weak as what people are concerned about, because some of these forecasts were made at the time when things looked really particularly dire. But sure, right now we're thinking the manufacturing sector will subtract 2 percentage points off of GDP growth. That would mean, by the way, that export growth slowed down to about 13% in 2022. Yeah, that will slow further, and if the global economy gets hit harder, then it will get hit harder for sure.
Yeah. Well, and it's interesting because when we discussed this last year, we were actually a little bit more negative on manufacturing.
I was quite negative last year, and what saved us, as we talked about in the presentation, is all these factories coming. And that's why you had in your slide the yellow thing about we were predicting a big slowdown in export growth to the U.S. And in the end, what happened is export growth to the U.S. slowed from about 24% in 2021 to about, call it around 13% in 2022. See, I thought the hit was going to be a lot bigger.
So it still grew.
So it still grew, yeah.
It just grew less.
It grew less, but I thought we were going to get hit harder because of the big slowdown in the demand of stay-at-home products and this kind of stuff products made in Vietnam. But what balanced that off is so many factories moving here.
So yeah, and I think it's important to think about in a sense, the demand may be slowing, but there's just more products that are made in Vietnam that might have been made in Vietnam and made in China.
Yeah, exactly.
And so the demand number, might actually still be shrinking.
Yeah.
It's just that more of it's actually being made in Vietnam.
Yeah.
Okay, Ismail, a question to you. We didn't really touch on this, which is trading volume. So let me just go back here. I missed the question. Apologies. Okay, well, let me put on my glasses here. Okay, so we understand that average daily trading volume is off the COVID peak, but actually still quite healthy. Do you expect kind of a move up from here? And as you talk to your analysts and you talk to the various brokerage firms about what their volumes look like, what is the expectation, if there is one, about where you see trading volumes in the retail consumer in terms of coming back in a more meaningful way?
Sure. So ADT last year for wholesale alone fell to, I think, 439, and that's down from 2021's $953 million. The ADT has indeed been declining since the first quarter because the local retail investor sentiment soured after all those domestic issues that we just discussed. In terms of how it's going to go forward, there's a couple of factors that probably needs to be pulled for this volume to get even higher. In very general sense, you want to improve domestic investor sentiment to push ADT higher because that in itself feeds into a higher market level. Again, there's charts that show to suggest that's always the case, not just for Vietnam, but for many markets. And we think the path to that outcome may have to be foreign investor-led at the onset and premised on the absence of those domestic issues seen last year. In other words, no high-profile investigations, clarity in corporate bond refinancing, and lower interest rates. The margin selling pressure has largely abated, and that should buoy the market also. Many of the retail holders were flushed out with the market sell-off. The VNI hit its 2022 trough in November, December, and the bulk of corporate shareholders that may have been forced selling their pledged shares for margin loans should have passed. So, the bottom line behind that is those factors of lower interest rates, clarity in the corporate bond refinancing, no high-profile investigations, that probably stokes up that animal spirits back into the domestic retail base again.
Excellent, thank you. And here's another question that came in. It's a little bit related, and I think it's a fantastic question. So, Paul, thank you very much. We'll go to Michael, and I have some comments on this. So, has the government understood that the way they handle the communication regarding the anti-corruption cases, not what they did, but the way they handle it, how that's had an impact on the capital markets, and do we see any potential changes on how they will handle maybe future?
Yeah, that's a really great question. I think they were quite surprised that they hit 8% GDP growth in the stock market. No, I understand that, but I think that was quite shocking to them, and that was because of this whole issue. So I think that they do pay attention to that, is what I'm saying, and I think that kind of woke up some people about the importance of this type of issue, communication. My personal feeling from our own communications with policymakers and from our own things we've been asked to help and give advice and this kind of stuff is frankly speaking that they're still digesting it and that they're taking it very seriously. So I think it's something they do care about, but they're still kind of processing what happened last year. That's my guess.
I'll frame it, I don't know if I'd say it a bit more positively, which is I do think, from conversations we've had, they underestimated the impact. So let's just be clear on that. And they do understand that from a messaging standpoint, they could have done more to say, here's exactly why this person's being arrested, here's what their impact is, here's what they're not related to. And so as we think about the arrest of Madam Chairwoman from Madam Lant from VTP, there ended up being impact on Saigon Commercial Bank. And not saying that there shouldn't be, but there could have been much more clear guidance from policymakers. And in discussions we've had, I think there's two things. Number one, at VinaCapital, we are huge advocates of transparency, and we do think this is healthy long term. But we agree that there could be a little bit more communication around what's going on. And so, Paul, great question. And we do think, to the extent that something happens in the future, it will be handled a little bit differently. Again, not up to us, but I absolutely think the people have learned. Yeah,
they're taking it seriously. They're not just blowing it off.
All right, Michael, I'm gonna rule you out of this one just because of technology and the audio. But Michael, any kind of closing comments?
I think that at the very beginning, I mentioned this idea that this will be kind of a re-normalizing year. That's clearly the case for the economy, but the economy is kind of easier to, like a spring, to come back to its equilibrium point. The stock market, is where it's driven by people's sentiment and emotion and this kind of stuff. I also personally think the stock market will be a renormalizing year and kind of go back to the long-term trends. But it's probably easier to see that happening with the economy. That's a kind of a no-brainer.
Yeah, and it's interesting. We've been talking to a lot of investors, kind of normal year-end conversations, both servicing existing clients as well as conversations with potential investors. And what's been really interesting is now at a valuation of 9-10 times forward PE, the domestic investors who were here, they got hurt. But the foreign investors who were largely absent the last couple of years are looking at this and saying, I'm not sure there's much downside left for the next 3 to 5 years. This is a great place to be. And so we've seen some inflows into our funds, into our segregated accounts. And so it's a wonderful opportunity to build a position or add to your position. So,
and bear in mind, by the way, that something we've talked about before is that historically, local retail investors tended to follow the lead of when they see these kind of smart money foreigners piling in, they're like, okay, I want to, that makes sense. I want to get into that too.
We saw a bit of that at the end of November, early December.
That's right.
Okay. So with that, I'll just kind of close it and I'll say, hey, everybody, thank you very much for joining us. As Michael mentioned, we will have our 2023 outlook in print, hopefully by next week.
Next week, definitely.
Okay. We'll also have a replay of this webinar, so if it was incomplete or you want to share this with a colleague, we should have it up on our website, VinaCapital.com, by Monday, Tuesday latest. But on behalf of the team, and Ismail, thank you for staying up late. I wish the technology was better. But thank you very much on behalf of VinaCapital, and we hope to speak with you soon. Thank you again.